matters, where your money matters to us. I'm your host today. I'm Tami Fratis, and I work for ACC Capital Advisors, a middle market boutique investment bank, which helps company owners either sell their businesses or make acquisitions to grow their businesses. First, today, I'd like to talk a little bit about market conditions and trends in the M&A world. We're having a great year. M&A deal values for 2005 so far are over $2 trillion year to date. And that represents more than a 30% increase of values compared to last year. So why is that? Well, we have relatively stable interest rates, we have lower inflation, and we have a lot of people, a lot of company owners who weren't selling last year who have decided, since there's $6 trillion of capital sitting on the sidelines on corporations' balance sheets, so they would be strategic acquirers, and private equity balance sheets, so they would be private equity buyers, that they want to come to market. So there's also a lot of cross-border M&A interests on the buy side. So there's a lot of international firms wanting to acquire companies in the U.S. for a couple different reasons. One, they don't want to have to worry about tariffs and where they are, where they're not, whether they're up, down. So that if they buy a company in the U.S., they can manufacture in the U.S., and then they don't have to import to the U.S. The other reason we have buyers looking to invest in the U.S. is because values are attractive in the U.S. relative to other economies in the world. So just to highlight a couple recent major deals that you might be interested in, Novartis made a $1.4 billion acquisition of a bio company. PNC Bank, which probably all know, made a $4 billion acquisition of Colorado's First Bank. And CoinShares did a $1.2 billion US IPO deal. So there's quite a bit going on. That's in the large side of things. On the middle market side of things, we're talking about companies that would have an enterprise value less than $200 million. So revenue might be 80 million, 100 million, 50 million. Really depends on what the earnings before interest, taxes, and depreciation and amortization is, because when you value a company, you want to do a multiple of the EBITDA, which is the earnings before interest, taxes, depreciation, and amortization. So to get up to 200 million enterprise value, you probably need at least a 50 million EBITDA, maybe 30 million, depending on your industry. So what are some attractive industries? Well, certainly you've read all about AI, and you've also read about other AI technology companies, and that's driving some M&A deals, as well as cybersecurity and healthcare, pharma, financial services. I mentioned Colorado First Bank, and any supply chain needs or digital upgrades. That's what's attracting attention on the sell side. So buyers want those companies. The outlook for the rest of the year is still optimistic. We think that the rest of the year will be very active, although I will say we're getting closer to the holidays, so deals might push to next year. And we are pretty confident that strategic deals are going to remain attractive. So now I'd like to take a question from our audience. We have a question from Nancy Rowe, Philadelphia, PA. What is the opposite of a capital market? So when we talk about capital markets, we're talking about stocks and bonds. We're talking about the public market. We're talking about IPOs. The opposite of that would be where I spend most of my life, the private markets or alternatives. So these are private companies. They're not public. They could be owned by a private equity firm. They could be owned by a family. They could be owned by the original founder. So thank you, Nancy, for your question. And if you have a question, please feel free to write in to us, and we're going to display the address that you can send your question to.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
So please reach out to us with your questions. Now we have an exciting guest on the show today, and even though his firm last name also ends in advisors, he's a different kind of advisor. We have Diego Kapelusznik from Raymond James Advisors. Diego, welcome to our show.
Hi, Tammy. Thank you so much for having me. It's a real pleasure to be here.
So tell us how your advisor on your last name is different from ACT Capital Advisors, which is a boutique investment bank.
So Raymond James is a fully diversified financial company. I am one of the advisors at Raymond James. My team, Roxbury Wealth Management, specializes in working with business owners, and specifically business owners that are going through a liquidity event, that are planning on selling their business or maybe raising growth capital to further their business. That's one of the things that makes me special, I guess you could say, in the cadre of advisors that are at Raymond James.
Well, I think, Diego, you're also special in that you have a JD MBA, which not everyone has. And so you have the credentials to tell us what is the current state of the economy? What is going on?
Yeah, that's an interesting question. And I think what we're seeing this year is that the economy has been very strong. I think you alluded to it a little bit in your presentation, but we had a slow first quarter where the economy retracted by 0.5 point. But the second quarter proved to be surprisingly strong with an annual growth of 3.3%. And part of that growth has been due to strong consumer spending, which has helped offset the manufacturing slowdown, but also lower imports as a result of tariffs, perhaps, which get subtracted from GDP. Now, we're waiting on third quarter numbers that will be out at the end of September, but annual GDP growth for 2025 is forecast to be around 1.7, which is more subdued than in prior years, but it's still a positive number. And anytime that we have growth, it's really a good thing to have, as opposed to being in recessionary or flat periods of time.
Right. And you alluded to the fact that tariffs may have had an impact on the economy with less imports. Are there other ways that it may have had an impact on the economy?
So it's hard to tell right now because tariffs take time to materialize, partly because businesses initially absorb the costs of the tariffs, or use pre-tariff inventory that they're sitting on. If there will be an inflationary impact, it's expected later into 2025, perhaps the fourth quarter, or perhaps well into 2026. So we'll really have to wait and see what happens. We're expecting that costs will get passed down onto consumers at some point, but we haven't seen that happen yet. Actually, inflation numbers are out today, and they beat expectations handedly. So far, we're not seeing.
I was going to say, so what does that mean by saying it beat expectations? Does that mean inflation is less than expected, or inflation is greater than expected?
It was less than expected. Okay. It was less than expected. Core inflation came out a little bit under expectations, which is very, very good.
That is good. And what about interest rates? Where are they headed? Do you expect a rate cut?
Yeah, we are expecting a rate cut of at least 25 basis points in the September meeting that's coming up in just a few days. And perhaps even a further cut to a total of 50 basis points by the end of the year. Could be that the Fed particularly with the numbers that are out today on inflation, goes ahead and does a 50 basis point cut in a few days, we see it more likely to be 25 and 25. But it's important to keep in mind that the Fed only sets the overnight rate, which is a short-term interest rate. Long-term rates are determined by the broader market. And while they have some influence from the shorter-term Fed rate, the overnight rate, it could vary substantially. So we have to see what happens with interest rates. That usually depends on the market's expectations of what inflation is going to be.
Okay, so we saw that inflation results were good. Inflation isn't as high as people expected. We saw the interest rates most likely, or we think interest rates will most likely come down. So what should investors be focused on then right now?
Yeah, so what investors should really be focused on is on having a solid financial plan above anything else. Regardless of the current macro environment, if they have a true and tested financial plan that focuses on asset allocation, meaning what the percentage of bonds they should have, what percentage of cash they should have, what percentage of stocks they should have, that's the most important thing that investors can really focus on. The economy is going to be good at times, it's going to be bad at times, but really having a financial plan and sticking to it, not being reactionary when the market goes down and selling when the market goes down, or even buying when the market is at the top, is really what's important for investors, and what we think they should turn off the noise that they hear and really focus on having a well-built financial plan.
Buy low and sell high, not buy high and sell low, right?
Exactly. Be greedy when others are fearful. Be fearful when others are greedy.
Exactly. And the one thing I love about working with Raymond James and your Roxbury Financial Advisors is you will provide a complimentary financial plan for qualified business owners or qualified individuals, correct?
That's right. We do that up front, and as a way to know each other, as a way to know our clients, our future clients, and for them to know us and how we work. We think it's important to not put a barrier in the beginning, and just offer them that planning for free. What we end up seeing is that the planning ends up being so valuable to business owners that they end up wanting to work with us and wanting us to manage their assets for them.
I would agree with that.
We see it as a great way of getting started without any barriers.
Right. And so what industries or sectors right now are you favoring, if any?
Yeah, so this could be different from the M&A world, but tech has been really the darling of portfolio managers for the past decade at least. It's really outperformed all other sectors handedly. But with interest rates coming down, we can expect to see a rotation into industrials, financials. Big banks are usually benefited by lower rates. They have to pay less to their depositors, and that means bigger profit margins for them. Healthcare, just industries that are CapEx heavy, capital expenditure heavy, because all of a sudden able to access money more cheaply. So these are some industries that investors should really be focusing on and looking at beyond just tech.
And what do you think about crypto?
Crypto, I think, has a time and place in a portfolio. But you have to be careful because there's a lot of bad crypto out there, just like there's a lot of bad stocks out there. And people tend to want to get in on the next Bitcoin or the next hot thing. And a lot of the times they end up getting burned. So it's very important when it comes to crypto to also look at quality, just like you would in companies that you're investing in stocks. Ethereum, Bitcoin, the bigger names are probably safer. But Raymond James doesn't work with crypto yet, at least. So we are very, very conservative when it comes to that. So we have clients that hold crypto, but they hold it in outside portfolios.
Yeah, I would agree with that. I'm very conservative as well. So how can investors manage risk then in their investments aside from crypto?
So that's a great question. And it really comes back to asset allocation once again, making sure that they don't have invested in the market the liquidity that they'll need in the next 2 years or so. If there's a recession, if there's a market downturn, a bear market, that could very well last a year and a half to 2 years. Market swings do happen. And so it's important for investors to have a cushion for immediate living needs that are not subject to those swings that are outside. Other than having that cash cushion, bonds can also be a ballast in the storm when there's a down market and play an important role in a well-diversified portfolio, particularly for high earners, municipal bonds, which pay tax-free income. And depending on what state you're in, if you choose municipal bonds from your state and your state has a state income tax, you're also able to have fully tax-free income both on the state level and federal level, and the yields are very attractive right now. So I would say that having the right asset allocation, not being invested in stocks for the things that you'll need in the near future in case there is a downturn. You don't want to have to draw from depreciated assets, right? You don't want to have to realize losses. You want the losses to be able to recover and just be paper losses and temporary losses. So having a well put financial plan that takes a look at their asset allocation, that takes a look at the investor's time horizon, meaning how long until they'll need the funds, their liquidity needs, and really their risk profile, right? You don't want to go too aggressive for somebody that gets nervous when the market has a downturn. You don't want to go too conservative with somebody that's younger and can afford to withstand the market downturns, knowing that in the end they'll have higher returns. So it's really a function of all those things.
Okay. So if I was younger, let's say I'm 35, 40-ish, and I am going into the family business, so I'm going to essentially take over the family business. Should I have a financial plan?
Absolutely. I think that it's important to have a financial plan as a sort of North Star. And it doesn't have to, a financial plan is not written in stone, right? It's an evolving document that we prepare for clients. So even if you're older, things change from when we first get together with the client and prepare the financial plan. There could be a divorce, could be a death in the family, could be a birth in the family. You don't know what life is going to throw at you. So it's important to stay active as far as the planning goes, to review a plan at least once a year, if not more often. So for younger folks that think, well, I'm so far away from retirement, maybe a financial plan's a little bit premature. Well, how are you going to know how much you're supposed to be saving, what rate of return you're supposed to be getting on your investments if you're not doing any financial planning? You're sort of, just going at it without a real help on your side with that. So it's even though things might change for a 35-year-old, it's important to at least have that guidance of where things might end up. And one of the cool things that we could do is we could do side-by-side scenarios. So financial plan doesn't have to end up in just one number or one result. We could have different results run side by side. If you're going to sell the family business at some point, if you're going to give it to the next generation, what the proceeds from those deals might be, we could show you side by side what difference that would make in your planning.
Well, also, if you're going to that point, if you're going to give the business to the next generation, don't you have to do a lot of planning because of the tax consequences?
Yeah,
in that?
you do. You want to look at trust structures as well. The earlier that you do it, it's going to be better. You're going to have better results. For example, if you want your kids to take over, and you know that at some point there's going to be a liquidity event, you might want to consider putting some of the shares of the business in a trust for your kids, so that when a sale happens, they don't have to pay estate taxes after you pass away and you give that to your kids, right? Estate taxes can take a big chunk out of your overall inheritance. So by using different trust structures, irrevocable trust structures, you could take a piece of the business out of your estate, gift it in life to your heirs, at a low price because the business is not liquid yet, hasn't been sold, and let the appreciation grow tax-free in the trust. So there's different.
Is that trust you're referring to, is that a dynasty trust or is that different?
It could be a dynasty trust. It could be a spousal lifetime access trust.
Okay.
There's different, it could be a charitable remainder trust. There's different types of irrevocable trusts that can be set up, and it really depends on the situation for each person and what makes sense for them, given their family dynamics, given their financials. But there's different avenues to go depending on the situation. Now, one of the cool things that we have at Raymond James is that we have a team of estate planning attorneys and CPAs, as well as tax attorneys on staff, that do a free consultation for qualified business owners, to take them through what they should be thinking or looking at as far as trust structures go, as far as the structure of the sale goes when it comes to taxation. Now, they're not going to actually draft trust documents or file tax returns, but they will go over general strategy and hopefully save the client in billable hours before they go off to their tax and legal professionals.
And is that just in a restricted geographic area, or do you do that all across the United States?
We do that all across the United States. We work with clients in all 50 states and territories. So.
And is it across all industries too, or do you have certain restrictions in certain industries you don't work in?
No, we actually work with folks across all industries.
Okay, great. And what I also gather is when we talk about inflation, whether inflation's going to go up a lot or whether inflation's going to drop, or whether interest rates are going to go up a lot or whether interest rate drops, that impacts your personal spending habits and your cash flow of your personal consumption. It sounds like you need to update your financial plan for those changes too.
Absolutely. And that's a great point, because when people think that they're doing their own financial planning, back at the envelope calculations, they often fail to account for inflation. So what they'll do is they'll say, I've managed to save so many in assets. I think I'm going to live so many more years, and I need to spend X amount of dollars. Do the numbers add up or not? But in doing that, you're really leaving inflation unaccounted for, and that's a place where you could easily stumble. So it's important to update inflation expectations to the plan. And when you're doing the financial planning, we want to be conservative and we want to look at the long term. So we really want to use historical averages for inflation, but those historical averages change in years like 2021, 2022, when inflation really skyrocketed, right? So that's a really good point, that you need to change your plan and tailor your plan as macroeconomic trends change.
Mm-hmm. And do you think maybe towards the end of this year or beginning of next year, do you see any recession coming?
It's hard to tell whether a recession might happen. They usually happen very fast and furiously. What we're seeing right now is that there's no clouds ahead, that the economy is growing. It's pretty strong. Inflation numbers look good. What we do have to keep an eye on is job numbers, unemployment, because unemployment has been going up with every reading month after month, and there's revisions that get done to those unemployment numbers that come out, and those revisions have really changed what the original numbers were for the worst, showing more unemployment. So unemployment is one of the things that we have to keep an eye on, because that could cause a contraction perhaps in the middle of 2026. But we have to see what the Fed cutting rates, what effect that has on the economy, because that is also going to have a stimulant. It's going to stimulate the economy, and it may avert a recession caused by unemployment. So far, so good.
Diego, thank you so much for your time, and thank you for being on our show. We have our next show, an exciting guest, Nick Easy, is going to be on from Canon Capital. And Nick, if I said your last name wrong, I apologize. But I thank you for your time today. We hope you learned a lot from Money Matters and Diego Kapelusznik from Raymond James. Your money matters to us, and thank you for sharing your time with us.